Hey, good morning, everyone. Marty Mazur. It's Thursday, the 17th of April, 2025, with your end of week market and economic snapshot. Getting it done early today. Hopefully, keep it quick enough so I can get it out to you this morning. Tomorrow is a holiday, of course. Happy Good Friday and happy Easter to all of you. So this morning, definitely want to touch on the market action, but I want to start with the action in the 10-year Treasury yield. And I'm just going to show you a 3-day chart so we can capture what happened yesterday. So quite a bit of news around, or news headlines around yesterday's speech by Fed Chairman Powell at the Economic Club of Chicago. I believe that's where he spoke. And had to do with his view, the Fed's view of potential inflation, the result of tariffs and its impact on the economy, even whether or not the president can fire him, and so on. So I wanted to kind of put the current dynamics into perspective, because in his speech, it could be definitely viewed as a hawkish speech, meaning they are not the least bit interested in cutting interest rates anytime soon. In fact, what you're also going to receive today for sure are my quotes of the day, and a couple of them are focused on the Fed and a bit on Powell's speech yesterday. So this is right around when he was talking. Okay, so this is the 10-year yield actually going down. So he received intense criticism this morning from some pretty high places about the fact that the European Central Bank actually cut interest rates a quarter point today. And the Fed is stubbornly staying pat. Okay, so the desire then would be for interest rates to go down, and the intuition is that if the Fed cut interest rates would go down. So let me remind you that the last time the Fed cut interest rates, mortgage rates actually spiked higher. Bonds sold off, and the 10-year went up, despite the fact that the Fed cut the Fed funds rate. So it's always important to remember that the Fed funds rate is going to impact things like the prime rate at banks, short-term, credit card loans, auto loans, but it is not going to affect market-based rates like the ones that impact mortgage rates or mortgage rates themselves. Those are going to be largely impacted by the outlook for the economy, the outlook for inflation, and so on. So when the Fed cut interest rates the last time, it was viewed that it cut into a situation that was not at all recessionary, at least in the market's view, and therefore juicing the markets more via cutting interest rates would actually be inflationary. It would help the economy heat up. So isn't it interesting that yesterday, when he pretty much dispelled any notion that they're ready to cut rates, the 10-year Treasury yield actually went down, which is what I think the powers that be would like. And therefore, the price went up at that point. So we just have to be careful what we ask for. It's all about timing, and it's all about macro conditions. The other thing that's been very interesting and worth noting of late is the dollar. What's also a bit counterintuitive right in here is that as yields have spiked up, which they have during this time period for the most part, the dollar has continued to fall. Now, in currency trading, there's a huge focus on interest rates. The country with the higher or rising interest rates often has a stronger currency, because the people who buy that currency can potentially get a higher yield. There's a lot of carry trade that I've talked about in the past that involves borrowing in incredibly cheap yen terms with interest rates very, very low, and buying things and depositing the money in other jurisdictions where they can get a better rate of return on it. So on borrowed money that's not costing you virtually anything, you can make huge returns as long as the currencies behave themselves, which is partly why we've been very, very bullish on the yen, which is paying off nicely since we added that position. I've made the case that I think the yen will be the best performing developed market currency in a crisis situation, and that is exactly how it's played out so far. So we'll see if that continues. So then what's going on with the dollar? Well, there's been speculation that foreign entities, foreign central banks have been selling treasuries, but apparently the action at the auctions of late do not really support that in 2025. There definitely is evidence, and this is something that we talked about and anticipated happening, that there's been quite the rotation out of U.S. equities into things that are denominated in other currencies, including things like European equities and certainly Latin American equities this year. And a lot of that speaks to how well our core allocation has done this year in the face of a really tough U.S. market. And so that would be money rotating away from U.S. stocks, therefore selling the stocks and the dollar and buying the currency that they repatriated to, if you will. But from what I understand, the last several years, 70 cents of every dollar that's flown to the U.S. market has actually come from a foreign entity or a foreign investor. Therefore, the risk of serious underperformance of the U.S. is very much there when we talk about curing trade deficits and the things that are going on today. Remember, the trade deficit, which I'm not saying isn't problematic in some respects, would mean less money out there to flow back into our capital account. The trade deficit is captured in what's called the current account. Foreign direct investment into the U.S., which we have a big surplus in, is captured in the capital account, and that's been very supportive of U.S. equity prices, of U.S. yields staying low, and so on. And the administration, I think, flagged that early. They said there's definitely going to be some pain. Scott Bessent said there's going to be some detox necessary if they do what they believe they need to do at this juncture. Okay, so let's take a look at stocks. We still haven't gotten back down to that level that we hit back here on April 4th or 7th, I guess. And then we retraced 50%. Remember, we have that blue line there. I said that is a place where technical traders often would sell, and that's exactly what happened. Came back, couldn't even quite retest it, and now we've fallen back below the 38% retracement. And what I mean by retracement is we've had this 20% decline, and this is the market retracing a certain percentage of that. These Fibonacci retracement levels, the key are the 38, the 50, and the 62. And it is fascinating how well these things work on behalf of technicians. Another point worth making is how fast a bear market can wipe out years of return. Typically, it's multiple years. And here we just had, a 6-week move that's taken us all the way back at the bottom to January of 2024. Even where we sit right here today takes us back to, you can pull this all the way back to May of 2024, right? Even after this rebound. So if you've been somewhat cautious because of the setup, valuations, macro setups, as you can see in a virtual heartbeat, you're right back where you were to the point before you thought you were missing out on everything. So that's what we have to be cautious of, folks, because bear markets can break hearts and they can take back multiple years of returns. In terms of 2008, took us back like 13 years in the market and then took 4 years to recover. So tough stuff potentially in a recessionary environment. We are hedging against that kind of risk and doing our best to mitigate it, and then ultimately be in a great position, we think, or we hope, to take full advantage of it if and when it comes. But in the meantime, we want to do our best to perform even in these difficult environments as well. So the technical setup right here, not really clear, at least on the daily chart. I could point to the short-term charts and give you, what to expect over the next few days, but that's not our time horizon. I did say in here that we expect, our base case is that this will get hit again and then ultimately penetrated, but we could spend weeks, meandering above this level. That wouldn't surprise me at all. Yesterday, the White House announced great talks with Japan, and I think that was bullish in the futures market overnight. Right now, as I speak, the S&P is up about 0.29%. The Dow, thanks to United Health, is down today, and the NASDAQ is actually down a little bit. The NASDAQ 100 is down 10 basis points. We're doing fine, actually. Looks like 2/3 of our positions are in the green so far today, including things like U.S. industrial stocks and so forth. So the U.S. market actually isn't doing nearly as bad as what the Dow is suggesting right here. I think I'll just leave that one there. And then on the NASDAQ 100 index, Similar look pretty much across the board. The technicals line up the same. The monthly charts look really scary. Long-term charts are showing signs that they tend to show when a bear market is upon us and so forth. And I've shown you that, and I'll update you on that here pretty soon probably as well. And then lastly, just to look at gold. Gold is getting pretty stupid here in my view. We are long-term bulls on gold. We think it makes a ton of sense to own for the long run. I think it is way overdone right here, or somewhat overdone, I'll say, but I thought that right in here as well. So I think we've got some gaps to fill in here with gold. Often in technical analysis, you will point to these gaps that tend to get filled at large percentage of the time. So you had this big gap up right here. And so if that were to get filled, GLD, which reflects the gold price, would get down to about 300. And then, you just gapped up along the way. It would make perfect sense to me, even though we're long-term bullish, to see gold give back a pretty good chunk. And when it starts, because of all these profits that have been captured here in a short period of time, you could see people wanting to capture those profits. Certainly if the dollar begins to gain steam, it looks like that correlation may be coming back here, or the negative correlation between the dollar and gold doesn't always work out that way. Gold can be bought by central banks, which clearly they have been. It can be bought when the dollar is rising. When the world's freaking out, typically the dollar is the currency that's considered a safe haven. Hasn't necessarily worked out that way of late. I do think the yen's probably going to do better for the reasons I mentioned. But anyway, so gold is out there. If we were to get a few more days kind of up in here and then gap down, that would be an island reversal pattern, and you do not want one of those. They're high probability patterns that when they work out in both directions, this would be a top. You tend to see some pretty noticeable declines if that's exactly what happens. So it's way too early to say that, but this would not surprise me the way gold's been acting right here. So I would be cautious on gold. We rolled our hedge up closer to the money yesterday just to protect against something like this, because we have a pretty good position there that's been really, really good to us the last couple of years, this year in particular. Just had a second thought. I do want to share one more thing with you, or a couple of things here. This is from Peter Bookvar, someone whose research we respect, and we pay for his daily missives, and he touches base on a lot of data, so it's really good stuff for us. But anyway, so let's see. In this one, the April Philly Manufacturing Index dropped sharply to negative 26 from an up 12.5 and well under the estimate of up 2.2, and follows the negative print seen in the New York Regional Index. It's also the worst print in 2 years. New orders plunged 32%. So not a rosy outlook, at least in that region's manufacturing space. He featured in one of his posts today some company commentaries. Ford sent a memo to its dealer network and said they're going to be raising prices in the future, which is expected to happen with May production. Hermes on how they will deal with tariffs. We are going to fully offset the impact of these new duties by increasing our selling prices in the U.S. from May 1 across all of our business lines. From Alcoa, and talking about tariffs on aluminum, that instead of helping them is hurting them actually. And this is from Alcoa's spokespeople. While the U.S. Section 232 tariff structure has been in place for some time, in March the tariff increased from 10 to 25%, and the exemption for Canadian metal imported into the U.S. was removed. This is the most material impact to Alcoa, as approximately 70% of our aluminum produced in Canada is destined for U.S. customers and is now subject to 25% tariff costs, which total an estimated $400 million to $425 million annually. Of course, there's a higher Midwest premium, which offsets some of this cost and certainly benefits our U.S. smelters. But currently, the net annual result is approximately $100 million negative for our business. And that's not all. While alumina and other raw materials are excluded from the reciprocal tariffs, there is a portion of our input materials provided by Chinese suppliers that is now subject to the high reciprocal tariff. We expect these tariffs will increase our input costs by 10 to 15 million annually, and there's no suitable replacement suppliers. United Airlines, this is really key in terms of what we're looking at. It's clear the softer macro environment is driving both volatility in the market and softer demand for travel. As we would expect in times of economic weakness, we saw the weakness magnified on off-peak flights. That's why we were canceling more off-peak flying and lower utilization going forward. Weakness in the main cabin was somewhat offset by premium performance. So folks with money are still spending money, but that may be waning as well. In the last few weeks, we have reduced domestic capacity for the summer in our sell-in schedule by 3 points, with one more point to be removed shortly. So far, we have seen no deterioration in high-end consumers' willingness to purchase a premium experience. Again, that speaks to this big bifurcation between what's happening with the upper income earners versus kind of the desperate state of affairs when you get down into the lower income earners. D.R. Horton, the home builder, the 2025 spring selling season started slower than expected as potential home buyers have been more cautious due to continued affordability constraints and declining consumer confidence. Our tenured operators are responding appropriately to market conditions by increasing sales incentives where necessary to drive traffic and incremental sales while carefully balancing price versus pace to maximize returns. Now, American Express, who really caters to upper income earners for the most part, theirs is still a bright spot. Our performance across key areas, including card member spending, customer retention, demand for our premium products, and credit performance continue to be strong across our customer base, consistent with, and in many cases, better than what we saw in 2024. So definitely Amex is a very important to watch right here because it is the upper income consumer who has really been doing the heavy lifting for the U.S. economy of late. In a nutshell, I think what we can glean from this and many other earnings statements, by the way, or earnings comments or company comments, is that lots and lots of concern out there, lots and lots of uncertainty. I do know that projects are being delayed and if not entirely put off, data center build-outs, so forth. There's just a ton of uncertainty out there. And folks, in closing, let me remind you, in no way, shape, or form am I or are we making a political statement here. Our job on our clients' behalf is to stay very clear-minded, see the world through clear glasses, not colored by any personal biases, and just look at the effects of what's going on, how policy seems to be impacting macro conditions, factor that into our analysis, factor that into the allocations that we make, and also be very open-minded to the notion that things could actually change in a hurry. The worry is, as I said a day or so ago in the written blog, is there enough negative momentum at this point already to see recession in 2025, and we should be very concerned about the level of equities, even at these levels, which are down a bit since the beginning of the year, in a recession scenario. I will leave it there. Hope you have the best of holiday weekends, folks. I appreciate you so much for watching and listening, and I will be back very soon. Take care. Bye-bye.